Okay, let's unpack this. The year is ending. Globally, people are, checking out, focused on winding down and getting ready for the new year.
Right.
But if you were watching the digital asset space this final week of 2025, the infrastructure and the regulation, they just sprinted right through the finish line.
It was a fascinating paradox, wasn't it?
It really was.
I mean, on one hand, you have the Santa rally that everyone was waiting for,
Yeah.
and it's completely stalled out, hit a serious wall of resistance right near that $90,000 mark.
Sent the short-term sentiment crashing.
Exactly. But at the same time, behind the scenes, you've got these massive foundational structures being locked in, finalized legislation in the UK, the EU, even Switzerland.
And that's really the mission for our deep dive today. We have to synthesize these two sort of contradictory realities. We're looking at the top 10 most consequential developments that are defining this transition into 2026.
And the paradox is right there. Short-term anxiety is dictating the price, but the long-term regulatory and technological maturity, it has never, ever looked stronger.
Exactly. We want you, the listener, to really understand that the shifts we saw this week in legislation in infrastructure, they fundamentally outweigh any temporary volatility.
Absolutely. So let's focus on the permanent changes first.
Let's do it. Let's start with that global regulatory blueprint. We saw 3 major jurisdictions, the UK, the EU, and Switzerland, all take these concrete, decisive steps.
Yeah,
Starting with the UK, which just hit a monumental milestone.
that's right. The UK government, they officially published the final secondary legislation.
And this effectively brings everything.
Everything, all crypto assets, right under the regulatory perimeter of the Financial Conduct Authority, the FCA.
So this is not just about exchanges anymore.
Not at all. This is comprehensive.
Okay, so what does that mean practically for an institution that wants to operate out of London?
It signals irreversible intent. The ultimate goal, and this is the crucial part, is same risk, same regulatory outcome.
We've heard that phrase before.
We have, and now it's law. It means digital asset activities will be treated with the same rigor, the same compliance requirements as traditional financial services where the risks align.
And the timeline.
Full operation is set for 2027, but finalizing the legislation now, that means the foundation is laid. It can't be easily undone by, a change in political winds.
So institutions can start building with certainty today.
That's the key.
Certainty.
That level of certainty is exactly what large funds need. Okay, let's go across the channel to the European Union. MiCA.
Yeah.
The Markets and Crypto Assets Regulation. It just entered a critical new phase for transparency on December 23rd.
And this is where the technical details really matter for compliance teams. It sounds boring, but it's huge.
What happened?
Mandatory formatting requirements for white papers just became effective. Specifically, they now require the IXBRL format.
IXBRL. Okay, break that down for us. Why is that a big deal? Think of it like creating an internal API for regulation. It standardizes all the data, the technical specs, the risk disclosures, the financial projections. Everything presented in a white paper is now in a machine-readable format.
So instead of a regulator or a big analyst having to manually scrape a bunch of different PDFs, they can just pull standardized data sets instantly.
Precisely. It allows them to build automated risk assessment systems, basically overnight. It makes it so much easier for institutional players to compare projects, to assess risk profiles consistently across the entire Eurozone. It just removes all that friction.
And at the same time, the European Securities and Markets Authority, ESMA, is finalizing that central register.
Yes, the Central Register for Authorized Service Providers.
Which is basically the formal gatekeeper for who can legally operate in the EU.
That's right. And if you connect these 2 points, the UK's move and what the EU is doing, it shows that regulatory adoption is shifting away from the if question.
And firmly into the how.
Firmly into the how. How quickly can we scale up these fully compliant, fully auditable operating environments that traditional finance just expects as a baseline?
Speaking of rigor and compliance, we have to talk about Switzerland. The country famous for financial discretion is now tightening the belt on digital assets.
They are. They announced that mandatory information reporting for crypto asset taxes will take effect starting in January 2026.
What's fascinating here is the global context. This isn't just a Swiss decision, is it?
No, not at all. This move aligns Switzerland directly with the Global Tax Transparency Standard, specifically CARF.
CARF, the Crypto Asset Reporting Framework.
That's the one. So this is them committing to an international standard.
So the jurisdiction that's been long associated with financial privacy is what?
Well,
Volunteering to be a leader in crypto tax transparency.
it's necessary. It has to happen. It sends a clear global message. Institutional adoption brings corresponding compliance burdens. They're trying to curb tax evasion, and it just underscores that maturity means accountability.
The days of using crypto for simple tax avoidance are numbered.
They're rapidly closing, even in historically discrete jurisdictions.
Okay. Unshakable regulatory foundations being built across the West. That is the story of the end of 2025.
Without a doubt.
Now, let's pivot and look at how the market actually reacted to all this certainty, which brings us to part 2, market consolidation and institutional rebalancing.
Because, frankly, the charts tell a much more nervous story.
They really do. This section is all about that immediate price action and sentiment and explaining why the year-end feels so cautious despite all this good news.
Yeah, and the stalled Santa rally is the main piece of evidence.
After a really strong push, Bitcoin faced some heavy selling pressure. It just consolidated right around that $90,400 level.
And you often see consolidation, but this felt different. This felt like hitting a ceiling.
Why? What are analysts saying?
Well, they cite 2 key drivers. First, the obvious one, year-end profit-taking. Investors are locking in gains after a historically strong year. They're managing tax liabilities, closing out their books for the fiscal year.
Standard procedure.
Totally. Second, and this is that perpetual headwind, is the macro uncertainty.
Still those hawkish tones from the central banks.
Exactly. And that just prompts caution when portfolios are being wrapped up for the year. It's a classic end-of-year psychological pause, just amplified by that big $90,000 resistance point.
And we have hard data to back up this risk-off mood.
We do.
The data from the final week of December it's pretty stark. Bitcoin spot ETFs recorded significant net outflows, over $140 million.
And that metric is a definitive indicator of institutional behavior.
It's not retail.
It's definitely not retail. When you see $140 million exiting the most regulated, accessible investment vehicle out there, you know it's the big players.
What are they doing?
They're strategically rebalancing. They are de-risking, moving liquidity back into cash. Maybe they anticipate a slow Q1, or they're just clearing the decks for new allocations they've planned for January.
So it's strategic caution, not panic.
That's a great way to put it.
But hold on. If institutional investors are pulling $140 million out of the market to de-risk, doesn't that fundamentally contradict the narrative we just built?
About regulatory certainty.
Yeah. Why the fear if the foundation is so solid in the UK, the EU, and Switzerland?
And that's the tension, isn't it? The institutional playbook often dictates de-risking into year-end, no matter how healthy the fundamentals look.
It's just part of the cycle.
It is. They meet their compliance goals, they see the macroeconomic picture, and they take profit. But that strategic move, it feeds directly into the market's psychology.
And that psychology is clearly reflected in our final piece of evidence here, the Crypto Fear and Greed Index.
Which dropped significantly.
Dropped to 30, squarely in fear territory.
The connection is undeniable. You combine the failed Santa rally, where the price didn't break through that resistance everyone was watching, with that $140 million institutional withdrawal.
And you get a very cautious outlook.
Exactly. The index just confirms the market is kind of catching its breath, waiting for a new direction, and that translates into short-term fear based on price expectation.
Not a technology failure.
No, absolutely not. And that's a vital point to stress. The fear is about price and macroeconomics, not the tech.
Which brings us perfectly to the most exciting part of this deep dive, part 3, the silver lining.
The infrastructure leap forward.
The stuff that happens simultaneously, completely regardless of the short-term price slump.
This is where we see true, fundamental growth that signals the long-term trajectory. And let's start with, honestly, the surprise story of the week coming out of Asia.
Mongolia.
Mongolia.
Really. Mongolia, not Singapore, not Hong Kong.
Mongolia, launching the world's first 245 blockchain-based securities market for over-the-counter, or OTC, trading.
And this happened on Christmas Day, December 25th.
The significance of this cannot be overstated. I mean, it's a truly humbling lesson for some of the more traditional financial centers.
How so?
Mongolia, working with Anady Global Group, has leapfrogged many larger economies. They've integrated distributed ledger technology, DLT, directly into their national finance markets. This is the world's first true 245 model. It breaks that traditional 9-to-5 barrier, using DLT.
That is massive. It's not a pilot program, it's their national OTC market.
It's real-world adoption at a national level.
And speaking of foundational growth that just shrugs off short-term price dips, HashKey Capital.
Yes.
They just announced the first close of their massive $250 million Fund 4.
And this shows exactly where the smart money is still flowing.
So contrast that $140 million in ETF outflows with a $250 million fund being closed for new investment.
It's a huge signal. This capital is specifically earmarked to accelerate global blockchain adoption, and crucially, to support the infrastructure projects that bridge the gap between Web 2 and Web 3.
So they're investing in the picks and shovels.
They're investing in the picks and shovels, not just the next speculative token. Their conviction is in long-term utility and mass adoption.
So we have new national markets launching on DLT. We have significant capital flowing into infrastructure. What about the major exchanges? Are they just sitting still?
Not at all. They're also enhancing their back-end systems, focusing squarely on trust and performance.
Because transparency and optimized execution are just... They're non-negotiables for this industry to mature.
Absolutely. Take Bybit, for example. They released their 29th Proof of Reserves, or POR report. 29th. This kind of continuous public demonstration of solvency.
Yeah.
It sets a really high standard of trust that institutional players now demand.
And on the retail side, we also saw an important upgrade for liquidity.
That's right. Phemex launched a major upgrade to its retail price improvement, or RPI, system.
And for those who don't know, RPI is basically a mechanism that helps small retail orders get better prices.
Exactly. It protects them from market slippage. It gives them tighter bid-ask spreads. These kinds of technical investments in reliability are what make a market trustworthy for everyone.
Okay, finally, as we close out the year, there's one technical factor the market has to watch closely.
The token unlock schedule.
Specifically for the decentralized exchange, Hyperliquid. Ticker is HYPE.
Right. A significant token unlock occurred on December 29th. It released about 2.6% of its circulating supply.
Now, why should you care about a 2.6% unlock? It sounds small.
Because it often acts as a real-time liquidity test for a protocol.
Okay.
When previously locked funds suddenly become accessible, that can translate into selling pressure, or at the very least, a lot of added liquidity.
So you need to watch how those newly liquid investors behave.
Precisely. Are they building on the protocol? Are they cashing out? It gives you a crucial measure of long-term holder conviction.
So what does this all mean as the curtain falls on 2025? If we step back, the tension is it's palpable.
It is.
You have short-term traders showing acute fear, while regulators and builders are sprinting forward, betting big on the long haul.
We've established that core tension, right? You've got regulatory maturity, the UK, MiCA, Switzerland, and this rapid real-world adoption.
Like in Mongolia.
And the huge capital injection from HashKey. All of that is surging forward, even as short-term liquidity sees that $140 million exit from ETFs, and the Fear and Greed Index sits at a chilly 30.
So the message is clear. While the price action stalls and the charts look cautious, the underlying infrastructure,
The regulatory framework,
and the smart capital commitment, it is all fundamentally stronger than it was just a week ago.
the foundation is set for 2026.
Yeah.
Absolutely. The whole conversation is shifting away from simple speculative investment
Moving toward
regulated, integrated, and reliable DLT use cases. The industry is professionalizing, and it's doing it very, very quickly.
That leaves us with our final provocative thought for you to chew on based on everything we've discussed today, from Mongolia's 245 market to Swiss tax compliance. The coming year will not just be about institutions buying Bitcoin. It's going to be about governments figuring out how to tax and regulate DLT applications that are running 245. So the question is, how prepared is your jurisdiction for a market that never truly closes?